Hello, welcome back. We're going to talk about Snowflake, a cloud company that has been a high flyer for a while and then fell down with the rest of the market, really, and the rest of the Nasdaq, I'd say, because it's a tech company. But this is a direct competitor to Oracle or Facebook or ServiceNow, and it's a company that seems to be doing well for a while, as you see here, but then all of a sudden starts going down, and now it's even more down even more, 23% after posting some quarterly lows. And this one serves as a very important example to talk about value investing, because we will examine the cash flow that the company is making and create a discounted cash flow model, see what kind of price it makes sense to pay for the company right now. And we're going to talk a little bit about growth and kind of compare the situation here and see what makes sense for a potential future investor here. So first things first, we want to start with taking a look at two important metrics. I always like to take a look at the outstanding shares, see if the company was actually diluting investors. And they were, as you would kind of expect, because the price of the stock was growing higher and higher. And so they were issuing more shares and selling to investors that were willing to buy, diluting the current investors at that time. And that's not great, of course. So the next thing that I want to see here and take a note about is the market cap, which is sitting at $81 billion, which is a very lucrative market cap, obviously, and we want to see whether it makes sense in terms of the financials of the company to be that high. The company doesn't have a PE though, which points to negative earnings. Let's take a closer look and see what is the company doing in terms of their income statement first. As with a lot of these growth companies, it does enjoy steep growth in total revenues here. Revenues are growing, although they seem to be suppressed in the last year compared to the previous year, is really. Still growing at a good rate over here. The cloud actually obviously is a very competitive space. It's something that we also need to be taking into account. The net income of the company, though, it has been negative, and so the company is actually not making any net income here, it's actually losing money. What about the balance sheet? The balance sheet over here, you are looking at the total liabilities for the company that are sitting at $1.1 billion and a total equity that's sitting at $5 billion. So at least they have equity, which, as you can understand, they built with investors' money because they're not making money from operations. This is what you see here. Additional paid-in capital is capital that's coming in from investors. It's basically you or somebody else, actually, that is investing in the company. So the next thing that we want to see here, and it's obviously the most important at the end, is the cash flow. And the operating cash flow from the company is barely in the green here. So just barely, and used to be negative here. But the company also has capital expenditures, as you can understand. And the cash from investing, which I actually missed, you will see here that the company is just investing in some market securities. So now you are looking at a company that is issuing shares and selling shares to investors, and then using this money, the proceeds, to buy market securities, so equities. So it's a hedge fund, basically. They don't seem to be investing in their operations, but rather they are actually investing in other stocks. So is that something that you would like as an investor? I myself would hate that. I like companies that invest in the open market, in securities and all that. But first, I want to see companies that are making good money from their operations and also investing some of their money, if not most of their money, in their own company. Because otherwise, I can just use my money to invest them myself. I don't need a hedge fund. So that's something to bear in mind. The next thing that we will examine is the cash from financing here, and you'll see that it was very positive back in 2021, where the company issued a lot of stock, obviously taking advantage of the high stock prices. And this is where, if you were a stockholder, they really diluted you. And if you were a new stockholder, you basically bought at a high price and then you saw the company's stock going down from that. The next thing is the free cash flow, which was negative over here till 2021, and just barely in the last 12 months seems to be going better than what it used to be. The multiples of the company are sitting insanely high at 73, 42. You want to be ideally looking at companies that have like 3x at most, for the most part. So as you can understand, this is very expensive here. What about the profitability? I mean, the company is not profitable, so this is negative. The solvency, The company doesn't have a lot of debt compared to its equity because they built equity, as we mentioned earlier from stockholders' capital. So they're not really in any danger of a default right now, at least in the next few years, I suppose. Now, the next thing that we want to examine here is if we are willing to pay to buy the company, how much should we be paying? And I want you to remember something which is very, very important, because before we jump to the discounted cash flow model that I have created, when you are paying for a company, think about it as you are buying the company. And so the company is actually right now costs $81 billion, and last 12 months it made $27 million in free cash flow, which is basically the money that was left over. So does it make sense to you? Like on first sight, $81 billion company, $27 million it made in the last 12 months. So how many years would it take you to get your money back if you paid 81 billion today? Let's maybe do the calculation. 81 billion, which is 81,000 million, basically. And we are going to divide by 27 here. And it will take you approximately 3,000 years at this rate to recover your money if you were to buy the company today, which is exactly what you're doing when you're buying stock. You're just not buying the whole company, you're buying a piece of it. So bear that in mind. And now let's jump to the discounted cash flow model here for Snowflake. Obviously, these values were in the negative, and this one is a placeholder. But in the last year, it's making a little bit of free cash flow. We're going to give it a discount rate of 13%, which is what I want to be making annually from my investment, and a free cash flow growth to use, which you can see the 5-year average free cash flow growth, it was in the negative. It only grew here. I guess it grew here as well. But I'm going to give it a conservative like 10%, which may not even be conservative actually when you're looking at this company. It may actually be too much even. And I'm still going to go with this one, just 10% for the next 10 years. Let's see what that gives actually. So the perpetual growth rate that I'm going to go with is like 2%. Is 1 or 2% is fine to use. Not a good idea to use more than that, generally speaking, because then you are actually outpacing the economy, the whole economy, like the US economy, and so that's not a good idea, or the global economy, to say it better. And so I have already filled in the outstanding shares in million here, and you will see that the price per share to pay today based on this model is $1, 1.4. Imagine how overpriced the company is that the discounted cash flow model comes back with this value. Now, some of you will say, okay, this is stupid, the company is not making money. Yes, but that's the point. The company is not making money, and you're paying 80 billion for it. And this model actually tells you what is the ratio that you're willing to pay today compared to the current stock price if these metrics were to happen in the next 10 years, which is actually a little bit optimistic also for these things to happen. Now, you may be saying, okay, the company is sitting at, let's say, it's going to be $203, and it will never go down to like 50 or 40. But let's take a look at where it was, the overview. It used to be at $400, and now it's $200, so it's 50% down already. So it could drop more. And the thing is, if it drops more and you are not making money and you own the company and the company is not making money, what do you have to show for? What's your margin of safety? And this is why we're making all these exercises with the simple discounted cash flow models. This is why this is very important. It gives you an idea of how close you are to the intrinsic value of the stock. Now, if that tells you that it's like 200, if it was like $200 and we are looking at 200, let's say actually it was 150, the discounted cash flow model, and we're looking at the company that's 203 right now, then you may have a case. You may be like, okay, I'm expecting that the company will actually outpace this growth. Maybe it will have like 20%, which I think is insane, but let's just say that's going to happen. And okay, I'm willing to pay a little bit of an extra just to get this company because I feel that they're going to be doing awesome in the future. So I would be willing in some situation like to actually pay a little bit more. But in this case, we're very, very far from where the company is in terms of their current stock price. It's very, very high compared to what they are making. And yes, they could be growing insanely, and they could grow to the company actually being worth, let's say, $50 in the next 5 years. but then you have already overpaid because you're paying today. And so this is why this discounted cash flow model is giving you a good idea of what you should be willing to pay as a value investor. And you shouldn't really care too much about hype, because hype dies down. And if there is a market downtrend, this kind of hype companies are going to be the first that are going to go down a lot. They could easily go down like 80%, 90%. We have seen those already happening. Many companies in the stock market right now that used to be Wall Street darlings and enjoying a lot of hype, going down because they had nothing to show for. And it's much different to hold a company like let's say Alibaba, which I have talked about a lot, and this company goes down, let's say 60%, and it's much different to hold Snowflake here, and Snowflake goes down 60%. Because Alibaba is actually making tons of money, and Snowflake is making no money. It's actually losing money for the most part. So which one would you like to hold if it goes down 60%, if both of those go down 60%? And this is what careful investing is about. Every company can go down 40%, 50%, 60%, but as long as they're making good money and it makes sense for you to purchase them today, and you are purchasing them at a price that gives you a reasonable margin of safety, you should be doing this kind of investment. You should be going for it. But if you're looking at the discounted cash flow model that gives you a $2, actually it was $1 with 20%, with 10% over here, gives you a $1.42 price per share to pay today, and the company is worth 200. I mean, I'm staying as far away as possible from this one. And I know that people may disagree, but hopefully my reasoning, and this is the value investing reasoning, will resonate with some of you, and I can potentially help with your investing and just give you some ideas. And think about it. I mean, at the end is obviously your opinion, and obviously you are doing whatever you want to do. If you want to buy it, it's of course going to be your choice. So that's what I had to say about Snowflake. And if you did like this video, and if this kind of content resonates with you, please subscribe, because that really helps a lot. And I'm making tons of content that again, like, align with this kind of investing and these concepts. And I'm also working on an application that I'm going to be giving to subscribers, and I'm going to be giving access to you. So you may want to subscribe and be around. And please like the video, because that also really helps with growing the channel a little bit. So that helps bring the content to more people. Thank you for watching this one, and in case you enjoyed this video, you may want to take a look at this that I made earlier, and it's about Lockheed Martin, a very interesting company which is worth your viewing, just to see your viewership, I should say, just to see whether it could be an interesting addition to a portfolio, your portfolio. Thanks for watching again. I'll see you in the next one very soon. Bye bye.